Welcome to the Pacesetter Pod, where we explore and reveal the perspectives, insights, and approaches to deliver great results and growth in your agribusiness through better execution. Here's your host, the Integration Pacesetter, Joe Mosier.
Welcome, Pacesetters of Agribusiness, to another episode of the Pacesetter Pod. Thanks for joining us today. I'm your host, Joe Mosier. The last couple of weeks, we've been in the midst of this sort of a mini-series within the podcast where we're trying to reimagine what the future of the cooperative business model might look like. We talked about, why a change might be necessary, what that model might look like. And the idea we're playing with, of course, is an asset-light model where, simply put, you strip away the focus and the emphasis on physical infrastructure and the physical movement of products owned within a captive cooperative system to actually providing more of an advisory base of service, kind of becoming the intelligence layer that sits on top of the physical infrastructure, the physical movement of inputs and outputs for the farming operations in the United States. And so we want to continue to think about this, both why does it make sense, what might it look like? We're being somewhat high level in some of these assessments, so it's kind of a survey course, but we will be digging in deeper into these ideas as we continue with this program over the months ahead. But in today's part of the mini-series, we really want to talk about what is necessary to make this happen and what is one of the biggest risks to the model. What changes in terms of the value proposition and the core assets of the business when you're now this, as we put it, intelligence layer sitting on top of the supply chain? And let's start with a relatively simple example. When you think about a conventional co-op, when a key person leaves, you feel that loss. Right? They know how work gets done. They know where the bodies are buried. They've known how to respond to different issues that have popped up over the years. They have relationships, trusted relationships with suppliers and customers and all that. But largely speaking, when a key person leaves, the institution will absorb the loss, right? Those relationships, the routing knowledge, the customer history, much of it lives, I'll say, in the building, but it lives, frankly, in the systems, in the processes, and in the operations of the organization. We've spent a lot of energy over the years looking to not dehumanize our businesses, but to maybe depersonalize them a bit, such that when somebody leaves for good or bad or unexpected reasons, all that knowledge doesn't leave with them. Now, you strip the assets away from a co-op, and that all changes considerably. Because an asset-light business model is likely going to be it would have to be very advanced in the use of technology. In the use of automation, it would have to have rigorous capture of information in all the different ways that data flows. And so while maybe the risk of all that customer information walking out the door with a departing employee is less than it used to be 10, 15, 20, 30 years ago, it's not risk-free. Because what happens is the asset-light model, as I imagine it, might actually magnify the importance of individual relationships in serving and retaining customers, especially when key co-op staff leave. And so given that there isn't really to date, a good option, a good example to point to that I'm aware of a co-op that has made the transition into being asset light to more of a virtual advisory enterprise, I have a theory. And the theory is that even if a customer rarely goes into the elevator for coffee to review scale tickets, or they rarely go to talk to the agronomist about some of the formulations and yield data and look at some of the maps together, or they almost never go into the mill office to see if the nutritionist is at her desk today. These locations, even if they're not populated by your customers on a regular basis, they still carry weight. And they signal permanence in the community, in the mind of the producer. And so our imagined future where the elevator is actually, now a farmer's bin as a node of the network, and where the mill office is a third-party co-manufacturer, and that means the nutritionist's desk is actually in her home office, we have a whole new risk. There's actually no physical infrastructure that might partially substitute for the departed expertise and the loss of a personal relationship. Right? There's no anchoring point in the community to aid in the retention of customers during a transition of their trusted advisor. And herein lies the conundrum. The asset-light co-op is only as good as the people running it, which makes it either the most exciting thing about the model, because you're now relying on people, not infrastructure, or the most terrifying aspect of it, because the elevator will still probably be in the same location in the morning when you get there, but there's no guarantee that the people will be. So in this type of program, it's very tempting for me to be cavalier with the ideas. I can trumpet the merits of a asset-free co-op. I don't have to get into the minutia of all the different sticky aspects of adoption and transition and operation. It'd be very easy for me to turn a blind eye to the tangled webs of issues that this might create and the real risks it introduces. Ideas are exciting, but I think we do ourselves a disservice if we let the excitement of an idea sort of blind us or preclude us from thinking pragmatically and realistically about what are the implications of that idea in the real world. And I don't want to do that on the show. I don't want to skip past those things. And the asset-light cooperative idea is no exception. So thank you for tuning in today. Before we get into today's episode, a quick reminder to like and subscribe to the show wherever you get your podcasts. Please leave us a review to let us know how we're doing. It is the best way you can support the program, and it does not cost you a thing. So to start off, let's be clear here about something. Technology is the enabler of this wild idea of an asset-light co-op. It's even the anchoring point, the foundation for this even being an intellectually credible scenario to sit here and wrench on for 3 or 4 weeks in a row, right? You cannot realistically envision any of this being possible without all the dramatic improvements and advancements in technology that we've seen in our industry up through 2022. Think about the 10 years before 2022, right? Turn of the century to that point. And then think about the hockey stick growth and opportunity creation that's been driven by AI since 2022, 2023. The tech here in this business model and this proposition is necessary, but it's not sufficient to win. Precision data, field mapping tools, market intelligence platforms, digital scale tickets, doing contract settlement or paying for your inputs from your phone, financial modeling capabilities. These are all real enablers of agribusiness and real enablers of agribusiness serving producers. But in the asset-light model, they stop being support functions. They stop being enablers. They become the primary delivery mechanism for member value. That's a meaningful shift. It's something to get excited about. But technology is available to everyone, right? Including your competitors. It can be purchased. It can be licensed. It can be replicated. And so a competitor can go out and buy the same agronomic data platform that your co-op uses. They can adopt the same digital logistics load board and freight tracking apps that maybe you were a pioneer adopter in your trade area, but you've now just trained all the customers and all the producers how to use it, and someone else can deploy the same technology, right? Rarely is this proprietary to an individual co-op. Not many co-ops are building their own native technology, and rarely is a third-party technology developer going to allow it to have exclusivity with one particular participant in the marketplace. You might lead the way in your trade area with remote sensors on farmers' fuel and LP tanks, and so you're ensuring they never go empty. And you've then been able to optimize the routing and dispatch of your own trucks. That's been a real game changer for you and for them. But someone else can come in and do the same thing. And technology is funny like that. It can give you this meaningful lead in the short term, but it almost neuters your ability to protect that lead over even short time horizons. You're constantly needing to advance it. So what the competitor, though, is going to have a much harder time buying is the agronomist who knows how to turn that data into a recommendation, specifically a recommendation that the farmer is going to trust and they're going to act upon. And so in other words, as we think about this new world, technology is going to set the floor, but talent is going to determine the ceiling, right? So take technology as a given. The differentiator, the accelerator is going to be the people. So how does the co-op adjust to this? Right? Think about the governance implications for co-op boards that are used to approving capital expenditures, that are going to go out and buy physical assets, that they can look at, they can drive past, they can put their eyes on. And now all the capital expenses are going to go into technology investments along a whole new set of value drivers that are going to be built around people, not places. Technology investment looks different. Right? It's faster moving. It's harder to depreciate. The ROI is sometimes less tangible. And a strategy built around a set of, technology capabilities that are operated and acted upon by humans, getting back to the talent piece, not infrastructure, is wildly unfamiliar to us. So let's kind of marry these two things together. So I know I'm talking about talent and technology concurrently here, and I don't want to confuse anybody or lose the point. But how many of you ever heard of the term acqui-hire? So it's aqua as an acquisition and hire. And so what it is, it's a trend, not even a trend. It's a steady drumbeat in the technology space where technology companies, one company buys another one, not for reasons that are necessarily driven by a great product that has broad adoption and traction. The acquisition might not be driven by some exciting roadmap of everything that they intend to ship in the next 12 months. No, the acquisition is actually based upon the roster of the company that they're buying. The products, the market share, the sales, the revenues, the free cash flow, that's all great, but it's all secondary. They actually just want to get the people. Like, when was the last time that happened in ag? Can anybody point to an example in traditional agriculture or agribusiness where one company bought another one just for access to its people? I can't. I may be wrong, but I pay a lot of attention to this, and I can't think of a single example. If I've missed one, please, by all means, let me know. I'll do a public mea culpa and I'll call it out, but that's where we're at. So boards now sitting in this new tech-enabled, people-driven, asset-light model have to have investment literacy that moves from plants to tech, while also figuring out how we're going to build and direct and underwrite an organization where people are truly, in a way that hasn't been the case before, the competitive advantage that you have to defend at all costs. Suddenly all those banners and value statements of people being our most important asset, which we all hear and we sometimes believe, but we many times also kind of say, yeah, until such and such happens, and then the people are not the most important asset. Suddenly all of that becomes very discomfortingly true. People and the technology they use is really what drives the business. So as you could probably tell, I'm having a pretty fun time here playing with the notion of the asset-free co-op, but I'm not naive. And what concerns me as I think about this is that the talent that this model needs doesn't fully exist yet in our industry. So beyond the different ways the board needs to think about investment, the management needs about investment in the business, we might not actually have the talent model that we need to operate this intelligence layer sitting on top of traditional ag supply chains. The asset-light co-op will need people who can responsibly and effectively operate at, or even beyond the boundaries of what a conventional agribusiness management philosophy might allow. Right? People need to operate with broad autonomy. They need to be able to build kind of bespoke, individual, trust-based relationships with people. Not to say it doesn't happen now, but that's maybe not the entirety of the job. They need to be able to make judgment calls on how we're going to serve a customer without a transaction that's going to anchor that conversation. They need to be confidently communicate value in terms that a skeptical farmer may or may not find credible, right? We talked here earlier in this series about the idea of selling a recommendation, and assigning value to that recommendation, value to the time that it took to create the recommendation, to understand the farmer's growing conditions and production history, rather than giving that advice and that recommendation for free and subsidizing it with a product sale. Right? All these things can have a lot of pressure put on them.
Poorly executed mergers and acquisitions destroy more value than they create. They can set your company back years. To defend your firm's position in the marketplace, you need access to the leading practices that unlock the greater potential of your people, processes, and systems. If you are undertaking a company transformation or pursuing an acquisition as a vehicle to grow, set up a call with Joe by visiting www.moshercg.com.
Now, I do think the talent profile does exist for this type of person in the economy, but I don't think it's being produced by the conventional co-op career path. And I don't think it's being produced by traditional agribusinesses writ large. So here's where I see this going. I think the asset-light co-op will act as a filter in both directions. It'll be a forcing function for talent fit because it's going to require such a different profile of how you act, how you choose to act, how you perform, how you gauge success, how you contribute value, I think it's going to attract a lot of people who really want to solve novel problems. People who really love the ambiguity, right? They don't need to have sharp corners on every process and every problem to feel comfortable that they can go ahead and tackle it. And it'll similarly repel people who want the comfort of a defined operational, not in terms of plant operations, but just kind of an operational role. Like, here's your job, here's the boundaries of your job description, here's the processes and tools that you have, and here's what you do when XYZ happens. And at the extremes, and I'm oversimplifying here, leading an asset-light co-op, you suddenly want a band of entrepreneurs, kind of this island of misfit toys almost, who can identify opportunities, they can communicate value, and they can act where yesterday you wanted, they can take action where previously you wanted disciplined operators who knew the chain of command, they understand the right way work got done, they understood where the decision tree took them when they encountered some kind of a non-standard scenario. And I think over time in this environment, the people that are attracted to that model that you bring in, they're going to develop a skill set that is going to be genuinely valuable to the asset-free co-op, and at least in the front end, pretty hard to deploy elsewhere. So this is where talent becomes a differentiator and becomes a short-term defensible advantage. You get these people, you get not mercenaries, but entrepreneurs, folks that act, folks that create, folks that build, folks that are okay with a little bit of ambiguity and can have some tough conversations and want to be measured solely on their results. They're going to be attractive to everybody, but they won't necessarily fit in everywhere. They particularly won't fit into kind of a conventional co-op that maybe has more of the asset anchored type business model. They become, frankly, too entrepreneurial for the administratively driven incumbents. And I don't think traditional co-ops are all that administrative compared to the big corporate trading houses and crop input manufacturers. But, on a relative basis, the asset-free co-op is going to probably be much more like a scrappy startup than a sort of established incumbent. So the habits that the talent build, that proactivity, that flexibility, that outcome orientation, that comfort with ambiguity, they're going to be exactly, I think, things that a traditional agribusiness leadership team will want, but that traditional agribusiness's compliance culture will probably reject, or it'll exhaust them if those people go back to join them. So this might sound a bit hyperbolic, but I still suspect that it's true, that you'll actually curate a group of talent that will have the ability to generate outsized returns and probably will be very attractive to your competitors, but not really have a path to them going there if they're not following the same asset-light business model. As a brief aside, the reason I wanted to share this, I was the classic corporate operator. I figured out how to navigate complex matrix business units and functions. I figured out how to find out the way things were supposed to get done, right? I'd push up against the boundaries sometimes, but largely said, okay, this is the boundary conditions of how this work can be performed. I'm going to find the best way to do it within those conditions, within those established sort of parameters and guardrails. I figured out who to talk to when things weren't going as expected. And I've now been on the outside for going on 6 years. I haven't lost, I haven't devolved, I guess. I haven't lost my ability to connect with people. I haven't lost the ability to be disciplined in how I work, but I do suspect sometimes that I've been out in the woods a little too long. And I sometimes wonder if maybe I'm completely unemployable in a traditional job after years of kind of operating without formal guide rails, without a boss in any traditional sense. And so that's where I kind of think about, okay, what does it require if somebody has gone and worked in one of this new asset-light co-op model, that coveted talent? You have them because they have nowhere else to go until they do. And so back to the point, again, these same skills, the focus on building things, on action, proactivity, flexibility, outcome orientation, running towards ambiguous problems, those are skills that have high portability. Now, maybe there won't be a lot of places to land on the front end, but that doesn't make them... So the things that make your talent valuable are also going to eventually make retention more difficult, make these people flight risks. The very things that you hire them to do and to learn, and the things that they become good at, can be just as swiftly applied at the next co-op who's willing to give this model a run. So just like that technology I talked about at the start, where you were the first one to adopt a certain type of producer-facing technology, whether it was a soil mapping technology, it was drones in the fields, whether it was a online payment portal, a white label product from one of the large operators in our industry, whether it was remote monitoring and sensors in the energy business, whatever it was a differentiator for you until eventually it became ubiquitous and everyone had it. And that's what can happen to the people too. You're going to train these people. They're going to have these skills. Those skills will not be proprietary to you. You can't make them unlearn them when they offboard, right? And so again, the very things that make them valuable to you are going to be what's going to make them valuable to other people who eventually, I think, would follow into this model if it's proven successful. And this kind of shows how that value and risk is two sides of the same coin. A high-performing agronomist who's built all the relationships and who's developed all the tools to kind of establish this dominant book of business, focus on recommendations, not product sales, that's amazing. But now they have everything they need to go out there and go independent, right? So why would they need to work for the co-op if everything that they do right now, they can do with a laptop or an iPad and an internet hotspot from their truck, right? They lose the benefits, maybe they lose kind of the steady W-2 income. They might lose, there are trade-offs, of course, but at the core base of how they spend their time, they're trained now to go out and compete against you. So the asset-light model in this vision I have of the future has actually made them portable in the conventional model, in the way that a conventional model co-op never did, right? The elevator manager can't take the elevator with him or her, but the asset-light advisor can walk away with a book of relationships. Now, maybe there's some non-competes and some things like that you can hamstring them for a while, but that's got a shelf life. There's a cost of enforcement too. So, sure, if you're the first through the door in this model, there are probably very few places in the market that are going to tempt your top folks to go, at least for the first couple of years. But as soon as the model starts to work, as soon as you start to generate results, as soon as you start to create chatter in the marketplace among both your competitors, as well as the people that your competitors, the people that work for your competitors, you'll need to start looking over your shoulder. So given all this, given what we're talking about, I see retention as fundamentally an ownership problem for the asset-light co-op. And the answer to that is what I anticipate will be kind of, you need to think about this broad key man risk with advisor portability. And you can't solve it through culture initiatives. You can't solve it necessarily through compensation benchmarking. It's going to be some part of ownership architecture. And I think here we can, again, look to tech to learn something. The people who stay longest in entrepreneurial environments, as I've observed it, and I have a number of friends that have and are working for tech companies, a variety of, from startups to scaled enterprises, the people who stay the longest are the people who feel like they're building something that they actually have a stake in. Right now, folks are mission driven. They want to enjoy what they're working on. They want to feel like what they're working on is important and it's additive to society. And we know that this is a trend for millennials and younger generations as well. But it also looks like I have equity in this startup. Or maybe if the company is post-IPO, I now have stock options or restricted stock units. I have other sort of incentive instruments that are working to prevent me from taking everything I've learned about how to build, how to act, how to respond, how to innovate, to keep me from walking across the street to the competitor. Because suddenly the major skill sets I have live between my ears. So to be honest, I'm not sure what advantages or constraints the cooperative structure has here, but it's something that needs to be looked at. So I think the equity in a co-op is owned by the farmer, right? And there's already some pre-existing challenges with that. There's considerable retention and revolvement phases that I know some producers struggle with. And so I don't really see an avenue there of, if you've already got these restrictions on folks that have actually put cash into the business, that actually have equity in the co-op. And if they're already trying to work through those retention revolvement phases, I don't know how that you would actually make that meaningful for the talent as a form of retention. Now, I admit I'm way out of my area of expertise in this, and I could be completely wrong. But I think a creative board and a creative management team might be able to think about designing some meaningful levers for economic participation for those key advisors. So if you think about this asset-light model and say, okay, our people are going to be our differentiator. In fact, they're going to be our engine for growth and engine for success. maybe we need to find some ways that we can actually share in those outcomes. And sharing the economic outcomes with the employees has a lot of sort of alignment from a value base with the idea of sharing outcomes across farmers, right? It kind of is an expansion of the cooperative philosophy. So you have some sort of profit sharing that's tied to member outcomes that the staff in this asset-light model would participate in. Maybe you have some kind of phantom equity type structures. Maybe and I don't know if it's even possible, maybe there's some kind of defined contribution to patronage pools that are earmarked. A certain percentage of that pool is earmarked for top performers, right? So when the co-op does well and the members are doing well, if you're having outsized performance as an advisor in this business helping drive growth, you're going to do well in addition. So I'm not a lawyer. I'm not a compensation expert. I can't advise technically on any of this stuff as it relates to co-ops. So just take these as the musings of an unqualified guy with a microphone and a stream of ideas. Take it all with a grain of salt. But what we know is that the asset-light co-op as a model would need to develop some structures that create a financial reason to stay. And ideally, if there's room for it, ideally you create something that private organizations can't replicate, leveraging some of those inherent advantages of the co-op. I guess what I mean to say here is we're going to have to move past, when I say culture initiatives earlier, you can't just say, man, we got to give them a reason for them to say this environment fits me, so I'm going to stay here. It has to be more of, I have something here that I'd be giving up, because we know that that's a really meaningful retention lever to pull. The asset-light co-op that's looking to reduce talent flight risks is going to need to figure out how to make their best advisors feel like partners rather than employees, which is actually a pretty noble challenge. And here you'll need the board and top management to be aligned both in their intentions and in their action. Designing some novel retention structures is going to require the willingness, frankly, the willingness to share the upside, the economic upside with staff in ways that might be unfamiliar and potentially very uncomfortable to the membership governance model that we've known. But again, so much about governance will have changed in an asset-light cooperative model, the one that we're envisioning here. So it's a real constraint. It's something I think we, more than thinking about technology or customer retention or how do you manage quality with these third-party partnerships and distribution and movement of grain, all the other knock-on effects of how do you make this asset-light model work. I think talent is actually the biggest accelerator for growth. It's also the biggest constraint to sustain growth if you don't have mechanisms in place to develop and then retain the right people. And that, of course, is a perfect tee up for our fourth and final for now episode on the asset-light co-op, which will come out next week. We're actually going to tackle the challenge of how do you actually transition the business model. So we've talked about why the model might need to look different. We've talked about what a different view of that could be with asset-light. We've talked about the implications for technology and talent in doing that. And next week, I want to kind of get into the very uncomfortable and sometimes discouraging topic of, how do you actually transition this? So I'm having a lot of fun with this. I certainly hope that this has been thought-provoking, maybe even productively uncomfortable for you. I hope it's relevant to the work that you have in front of you. And what I want you to take away today is a clear-eyed view on why talent is both that accelerator and that limiting constraint to the co-op we're envisioning. And next week, we're going to get into, is this even achievable? And at what cost? And frankly, what are the odds of survival? Thank you, as always, for tuning in today and every week. I appreciate you being part of the Pacesetter community. I appreciate your commitment to turning strategy into outcomes and thinking bigger and differently than what's in front of us day to day. It means a lot. Let us know how we're doing. Reach out with comments, things that we've missed, things we can expand upon, things that either support or challenge some of the assumptions we made here today. Thanks for joining. I look forward to having you join us next time right here on the Pacesetter Pod.
This is thepodcastfactory.com.